Good morning. I'm Karl Kaufman, and welcome to the Morning Market Minute for Friday, April 22nd. Beware the tightening Fed. That's what the market in essence told us yesterday after Chairman Jay Powell said that a 50 basis point or half a percentage raise in interest rates was on the table for next month's meeting. The market was humming along fine until his comments hit the wire, at which point it reversed itself and took a dive. Speaking at an IMF panel discussion, Powell essentially confirmed what we already knew. The Fed is behind the curve in fighting inflation and needs to act more aggressively. The Fed has done a good job of telegraphing their moves. I'll give them that. They've told us well in advance what they're planning to do. So why did yesterday spook the market? The markets are forward-thinking. After Powell's comments, investors now need to gauge how big of a raise will happen at the June meeting and throughout the rest of the year. Markets are pricing in now the possibilities of interest rates rising to as much as 3% by the end of the year. Last year, the Fed blamed inflation on supply chain constraints, when everyone else knew that low interest rates and printing money for stimulus would mean that they'd be held to pay down the line. They called inflation transitory up until last November, when they made a drastic change from dovishness to hawkishness. Now they're playing catch-up to inflation, which is the worst it's been in 40 years. The last time there was a half-point raise was in 2000, during the tech bubble. The fear is that economic numbers will soften while the Fed continues to tighten its policy. That would most likely lead us into a recession. I'm not worried, yet. Earnings have been great so far. Just look at Tesla, American Airlines, and P&G. The job market is tight. Jobless numbers reported yesterday were close to a 50-year low. There's no question that the Fed's actions during the early stages of the coronavirus saved the economy, but what are they doing buying mortgage-backed securities up until this year? Why were they still pouring gas when the economy was on fire? This is a stock picker's market. If you invest with a longer time horizon in high-quality defensive names with a history of raising their dividends, you should be fine in the long run, regardless of the whims of the broader market. They say you should never fight the Fed, but you can protect your portfolio from their mistakes. I'm Karl Kaufman, and I hope you have a wonderful weekend.